Great. Thank you for having me. So Extra Space is a Utah-based S&P 500 investment grade self-storage REIT. We have over 4,100 properties in 43 states and the District of Columbia. This is the most properties under any single brand in the world. This scale provides tremendous advantages to us in several areas, and the highly diversified portfolio, very granular portfolio across many growth markets, removes volatility from our return series. About half of our portfolio is wholly owned, and the other half is held in joint ventures, primarily with institutional partners or under management contracts where we manage the property for a third party and have no ownership interest. Our management business is the largest, most profitable, and fastest growing in the industry by a long shot. And this structure provides several advantages to us, primarily the ability to grow during all market cycles and economic conditions. Our strategy is really focused on 4 areas. We are going to outperform over the long term, first by having a high quality, highly diversified portfolio across growth markets. Secondly, by attracting, developing, and retaining the best people in the industry at all levels, from the store to the C-suite. We are going to continue to develop and improve our technology platform and optimize the use of the largest data set in the industry. And then lastly, we focus on prudent capital allocation across all market cycles. Sure. Our company was founded in 1977, and we went public on the New York Stock Exchange in 2004. We've grown from a market cap at IPO of about 235 million to a market cap of about 33 billion at the end of the first quarter. In the 20 years we've been public, we have the #1 return series of all public self-storage REITs and the #3 return series of all REITs in any property type. The REIT structure allows us to focus on long-term investment in real property and real assets while maximizing our distributions, our dividends to our shareholders without paying corporate income tax. Over the last 10 years, our dividends grown by over 110%. So this is a focus of ours. Storage is a need-based product, and such needs such as death, divorce, having a baby, getting married, moving, they occur in all market cycles, in all economic conditions. So our demand exists across market cycles. So while self-storage performs best during good economic times, it also can perform well during bad economic times, especially when compared to other real property types. We've experienced declining performance recently because we were on this, kind of historical peak during the COVID years. But we've reached the bottom of that decline, we feel, and are beginning to experience positive trends, particularly in our very high industry-leading occupancy and improving customer rates. 2 trends that should benefit the industry going forward. One is a reduction in development and new supply, and that's because construction costs are up, interest rates are high, there's less availability of debt and less availability of equity for these projects. And then secondly is increasing advantage of the large operators over the small operators. And these advantages are in customer acquisition, pricing of our product, availability of capital, technology, and particularly data, which is very important on how to optimize performance. And so this should allow continued profitable consolidation of this fragmented industry. Sure. I think the biggest bear thesis I hear is that the recovery in the self-storage market is wholly dependent on the recovery in the for-sale housing market. And while the for-sale housing market is important to us, it is a demand generator, and its recovery would be a tailwind, it's really only a portion of our demand and must be considered in other types of demand and other types of moving, whether that's apartment to apartment or apartment to single family home or whatever, single family rental home or whatever. So we ask our customers when they rent with us why they're renting. And those who say they're renting because they're moving, any type of moving, currently stands at about 53 to 58%. It's highly seasonal. The highest we ever had was about 63% in the third quarter of 2021. So clearly a decline, but not as dramatic or drastic as many assume. And I think the evidence in this is in our same store occupancy. Our same store occupancy is currently over 94.5%, indicating both sufficient demand for our product and our ability to capture it. Well, for a long period of time, our superior platform, people, and portfolio have produced leading returns in our industry, and we're absolutely positioned to continue to do so in the future. And on top of that, our non-same-store business, our non-same-store property business, which includes our tenant insurance company, our management business, our joint ventures, our structured finance book, have supplemented our property level, store level returns to provide positive FFO growth, even in this declining period where store returns are flat to slightly negative. And this distinguishes us from our competitors who don't have these other businesses or don't have them to the scale that we do. So we are positioned to continue to outperform.